Welcome to the Youth Capital Podcast with your hosts Zac and Jonah Wenzel. Join us as we dive deep into the world of finance, business and wealth creation. Please note we are not financial advisors. All information on this channel is not financial advice. All content created by Youth Capital is created solely for educational and entertainment purposes only. Consult with a licensed financial advisor before making any investment-related decision. Enjoy the show.
Welcome back to the Youth Capital Podcast. Today we're joined by a good mate of mine, Reuben Saric, who I've stayed in pretty close contact with. We went to high school. Well, went to the same high school as Swanee as well, but I was pretty close with Reuben. We played a bit of junior cricket together back in the day, and we also went on a trip to America with the school through some STEM trip. Thanks for coming, mate. It's been a while since we properly had a chat. How you been? What's been happening?
Good, mate. How are you boys?
Yeah, not too bad. Thanks for coming on.
No, yeah, love what the boys are doing, so it's good to get onto it. But
what's been happening?
Not much. What about you? Just been working and studying?
Yeah, well, I've moved down to Melbourne, so I've just been chilling out for a little bit. Back up at home now before heading overseas in a couple of weeks, which is pretty exciting.
Yeah. Where are you going?
We're doing me and Swanee going to be in Bali together for a little bit, and then I'm going to fuck off to Southeast Asia for another, probably I don't know, I haven't booked my return ticket yet, so 6 to 8 weeks-ish. And then
haven't booked the return ticket?
Nah, so
it's going to be a good one, mate.
Yeah, bloody oath.
What about you?
By the time everyone's listening, we'll be overseas. Oh, I'm heading Bali, Thailand, Cambodia and Vietnam, and I'm organised. I've got a ticket home.
Yep. At least he's organised, Wensley.
Hey, that's boring. So we got pretty close with that America trip, mate. That was a bloody good trip, eh? Good fun that was.
Good story that, eh? So, how did we first meet? We both tried out for the cricket team together, eh?
Yeah.
For the area.
And then we didn't really get close till America.
Yeah, well, because we had the America trip, you had no mates. The only person you knew was me, so you had to stay in our room, and that's how we got close. That was fun.
Yeah, that had good fun.
That was mad.
Wait, so what are you studying? You're studying?
Yeah, so I'm doing a Bachelor of Business at Griffith and majoring in accounting and financial planning, and so that's what I'm studying. But I started out of high school. I got into at Griffith as well, advanced business, but it was just an honours course. That was the only difference. So it was pretty much just a Bachelor of Business, but you had to do a big, the big honours piece at the end of the degree. And so it was just an extra year, and I wasn't really keen on doing that. And so I was just weighing up my options, didn't really know what I wanted to do. So there's a local firm around here, does a bit of work experience, and I just was I'll put my hand up for that. And then ended up having a crack. And
that's the traineeship, eh?
Yeah, I just did work experience just to see if I liked it. And then during work experience, one of the bosses called me into the office, and I was shitting myself. I thought I was in trouble or something. I was like, what's going on here? But he pulled me in and he offered me a job actually, and I was like, oh, sweet. So I didn't really have to look. It found me, which is lucky. It's good when it happens.
So how did you get into financials and stock market, and you're doing accounting?
Did you have a passion for it beforehand, or?
Yeah, how'd you get into that?
When I finished school, I guess, as soon as because I turned 18 at the end of the year, so as soon as I turned 18, but I've always wanted to buy shares. It's just been something I had no clue what I was doing. Absolutely no knowledge. Just was I'm going to buy some shares. And
it's the best way to learn, though, 100%.
Yeah. I remember chatting to you, Wenzel. We had a little bit of a chat, when we used to still hang out and catch up, which we still do. Mate. We still do.
So sad, eh?
We still play a bit of golf.
Yeah.
But back in the day, I used to ask you because you had a few yourself, and then so that's when I ended up.
Thought I knew what I was doing.
Nah,
year 12.
You do, mate. Don't worry. We came through ComSec.
Yeah.
Through your recommendation, and just had a little bit of a browse. We'd look at different companies, and I loved looking at the charts, just trying to see which ones had a little bit of a drop because I knew you don't want to buy anything when it's at its highest. Like that's just, yeah. And then came across just BHB and Qantas because Qantas was in a real bad stage then. It was still
COVID
pandemic, still lockdowns. This was at the start of 2021. And so bought a few Qantas shares, like all I could afford pretty much. And I've made a pretty good gain on them, which I'm happy with. But that's sort of just how I got into it.
So obviously you're majoring in accounting. What like I know a lot of people just think accounting is just sitting there doing taxes and looking at balance sheet. What actually do you do, and what do auditors do?
Yeah, I know.
What's your job?
It's a bit of a misconception. Hey, a lot of people just think accountants, you just go to your accountant to get your tax return done. Like that's probably
what I reckon.
Yeah. Well, mate, I'm here to educate you. So, no. So there are tax accountants. Don't get me wrong, but they're not all accountants. So accounting's pretty much, it's the language of business essentially. Like it's a vital part for any business, small business to large, like personal. It's just, it's just about analyzing, gathering financial information and then presenting it pretty much. Like that's probably the most basic way I can define it, but you can split it into different areas. Like, so you have tax accountants, which are the ones like they do your tax return, or they manage a lot of businesses, give a lot of tax advice and like tax minimization and stuff for companies, because obviously tax is a big expense for anyone and any business. So you want to minimize it as much as you can.
Mate, tax evasion is the key to wealth, eh?
I knew you were going to say that one. So that's tax, and then you got audit, obviously, which audit is another area. Auditors are everyone sort of gets scared of auditors when you hear the term auditor, because you think they're the ones that are after you. They're trying, like, because you hear of a tax office auditor when you lie on your tax return, and the auditors are the ones that come and get you. But that's not always the case. Like a lot of auditors, they sort of give assurance to clients, and we do like a bit of consulting work with our clients. But an audit is like a process you have to do. A lot of businesses will have to do it. A lot of not-for-profits, and then all big companies, like all ASX companies, need to get audited. And for example, it's just a process. We pretty much just go through a company's like controls of their business, make sure their controls are working, like assess their risk. We look through risk areas, try and find any misstatement. The misstatement's pretty much just like, think of it as just literally a mistake, but we don't obviously pick up every mistake because we only look at ones of a certain size, something that's big enough to majorly affect financial statements. And then, from there we help them prepare financials and pretty much just make sure they're correct, so that when they present their financials to investors, or a lot of not-for-profits have to present their financials to governments or whatever, we just make sure they're correct. And it's just like that tick of approval sort of thing.
So you're currently doing your internship now?
Yeah. So I work full-time doing that, and then do uni part-time. So just 2 units a semester. Yeah.
Yeah, that's all right. Yeah.
It's a bit of a juggle, but
what do you actually do as a part of your traineeship? Like, what is it? Just accounting and auditorship? What was it called?
Yeah, just audit. Yeah. So,
so just what you explained before.
Yeah, nice. Yeah, pretty much. Like I'm mainly in audit. I don't do much other.
And you go to a few. I remember you saying you go to a few AGMs as well, and as a part of your job.
Yeah, like at a lot of businesses, the auditor is expected or supposed to go to the AGM, and so we do a lot of that for our clients. But
why is that
listed
important?
Companies or
no? So I'm just at a firm around the Northern Rivers area, so we don't do anything that big, but we do a lot of big not-for-profits and a lot of big charities and stuff. So they still have AGMs, and we need to go to them, and but not any listed companies. That's pretty much you'll only see Big Four doing listed companies.
So
Yeah.
different types of entities, small and big, or mainly on the smaller side.
Yep. So for us, we pretty much do a lot of incorporated associations and do a lot of charities, do a few companies, but yeah, like mainly the incorporated associations and what we do actually, I forgot to mention, we do a lot of trust accounts as well, like real estate trust accounts, solicitor trust accounts, because their legal requirement, they have to be submitted, but their audits are a little bit different. But yeah, anyways, I guess that counts.
So we're here, obviously, to educate. Well, I don't know much about accounting. I don't think Swanee does either. So we're here, we're going to look at a few examples and just talk about a few different things that you might look for when you're researching a new company. When you look through the balance sheets, obviously it's a massive part of it. And I know you mentioned before off record that you can fraud a few things. You can make things look a bit better than they are. What sort of things do you look for, especially when you looking into a new company?
And why is it so important, financial analysis?
Yeah. So, well, like Sam said on the previous episode, he went into it pretty well, actually, like saying, make sure you always do your own research. I think that's so important. Like, you can never really rely on your mate's tip off, because it's just always good. Check yourself. The best way to do your research as well is just look at financial statements. If you can understand them, but it is a bit of like, it's almost like another language to a lot of people, which
it is tough language. Yeah.
Took me a long time to learn, and I make them every day, and it still took me a long time to learn. But once you understand them, it's so helpful. Like it's probably one of the best tools in that's just my personal opinion. But yeah, one of the best tools. Because all the big ASX companies, obviously, they're publicly listed, so they have to disclose their
follow certain rules. Yeah.
But yeah, so they're always available to go through. And yeah, so yeah, I think it's important. And so obviously we know the four separate statements that you'll see on a financial report. So you got your balance sheet, which you mentioned earlier, Jonah, and then profit and loss, and then usually they'll have a statement in changes of equity, and then a cash flow statement as well. So they're the four main statements that you can read. There's a lot more to it. Like there's notes to financials.
It goes on for ages.
It goes on. Most of them are over 100 pages. But for a normal person who doesn't want to read all that, the best thing to look for is just those four basic ones, and they'll usually only be a page each. So yeah.
What in particular? What on those subtopics? What do you look for in particular? Like inventory or growth in revenue? Is there what certain things you?
Yeah. So
is it red flag or green flag?
Yeah. So it sounds pretty simple. You want to see a company making a profit, but a lot of times companies will display a profit. But that's why I think cash flow statements are so important, because cash flow is a little bit more, how do I word this? So with your profit and loss, you can sort of boost your profit up through items that you haven't actually earned revenue for yet. So for example,
chuck that screen up. Chuck that screen up from before, Swan.
Yeah, let's go. Let's have a look at the one we were looking at before.
Try and zoom in if you can as well. Yeah, I just want to touch on something you mentioned before. You said make sure companies are profitable. And the reason profitability is so important, and this is a bit off accounting, but is so that companies don't have to raise any more money. Because if they have to raise, the majority of companies, I'd say on the ASX, don't quote me, but I'd say the majority of companies are actually negative profit or making a loss, especially smaller companies.
Yeah.
And if they are in the red, so they're making a loss, operating loss, they'll have to raise more money, and then it dilutes the shares, which is always not in its shareholders' best interests.
I might add, it always depends on what you are right. It always depends on what the actual business's goal is as well.
With the 100%,
some businesses,
100%.
Mining companies, for example, they'll want to make dividends for their shareholders, so they're going to try and focus on profits. Whereas a lot of other companies are trying to research, so they're going to be willing to spend more money, and they're not too worried about that yet because they're more looking towards 100%. The future. But yeah, so we've got we got the
Can you zoom in on that a little bit, Swanson?
I dropped it, yeah.
So yeah, this is just a normal profit and loss for just an example we have. So Slater and Gordon, what's the code for that one on the ASX 20?
SGH.
SGH. So yeah, so that's the chart.
In a tough year.
Anyways, go back to the profit and loss for me. So we look, if you see down there in total comprehensive income for the year, they're showing a pretty, you'd look at that and you go, wow, like that's
Pretty
good.
healthy.
But
2 million. Yeah.
there's a lot of factors that go into that. That's not all that's money they make. Like there's a lot of non-cash revenue and non-cash expenses in accounting. So I'll quickly explain this as just a very basic accounting term or principle that we follow. So with normal like day-to-day, say if you're just talking from a personal level, you want to buy something, say, let's think of Jonah, for example, wants to buy a new golf club. Yeah. He buys the golf club. Once he buys the golf club and he goes to the shop and actually buys it, the owner of the shop hands him over the golf club, and then Jonah hands over the cash, or he'll pay for it with his credit card. So that transaction happens then and there. That's like a cash transaction. Whereas in accounting, obviously businesses can't always pay all the time. So that's why you guys would have heard of invoicing. So like businesses will invoice, for example. So at the end of the financial year, which is 30 June, as it says up there on the financial statements, Slater and Gordon, which is a big, as I'm understanding, they are a big law firm or group of law firms. I'm not too sure. Swanee, would you know a bit better than me?
$75 million ASX listed market cap company. Jonah, if you can get what they actually do.
Leading compensation and class action law firm focused on helping you access justice and compensation.
So, Swanee, if you just go to the next page, which is the balance sheet, I'll point something out. So the balance sheet essentially just shows all assets and liabilities of a business. So if you look at assets, you've got cash, for example. And so can you see that little receivables section there underneath cash and cash equivalents? So I'll ask you this, Jonah. What are receivables? I'll give you a crack.
Receivables, from my understanding, could be wrong.
Yep.
Receivables are transactions or money that you're owed that haven't actually been transferred and aren't in your possession yet.
Yeah, spot on. Good stuff, mate. So
it's off.
So they're showing a good profit, which, I mean, yeah, great. But a lot of that isn't actually theirs yet until the client pays it, because sometimes clients can't always pay for invoices because they might go bankrupt or whatever. It's very rare, but it can happen. So anyways, that's why I like to look at cash flows more. I know you've touched on these before, Jonah and Swanee. You have touched on cash flows a bit more. So a cash flow statement, I think it's on page 38 if you want to go to it, Swanee. A cash flow statement is essentially, it just shows cash that you had at the beginning of the financial year. It just shows everything that's happened, cash only. So it doesn't include things like depreciation because that's not actually a cash transaction. It includes only cash transactions all throughout the year, and then shows your closing cash balance for the end of the year. So this one's a bit of a better one to look for, because you can't really make these look good, whereas you can with a profit and loss. So this one's very raw and it's a bit more truthful. So
it's what you should actually be looking at rather than you.
Yeah, well, you can look at both, but like personally, this is what me personally I would look at. So if you look at these guys, so they're, as we noted before from the profit and loss, they're making a profit. Whereas if you look at this cash flows from operating activities, they've made that looks like to me a $14 million loss.
Yeah, shit.
So can you see the difference? So
Yeah.
they might. So you always that's why it's important to do your own research and have a look at all factors, because they're showing a $2 million profit on one page, and then on the next page they're showing a $14 million loss in cash flows from operating activities. So that is probably something I'd look at. But again, I'm not fully qualified yet. I'm only learning. I'm just talking about from a personal level and just what my traineeship has taught me so far. But there's people who are a lot more qualified than me, and they'll go into a lot more depth, and they'll look at a lot more factors than me, and they'll make probably a lot better decision than me as well. But from a basic point of view, from somebody who's only been involved in the investing field for a couple of years, and I've gained a little bit of experience in accounting, that's something that I'd look at for sure.
Yes.
And ultimately, so the cash flow statements cuts out a lot of the BS from the other financial statements.
Yep. So a cash flow statement essentially excludes all non-cash transactions, which is things such as depreciation, which again, like depreciation will make it like in a lot of companies it can be a big expense, whereas it's not actually a cash transaction. Obviously, you guys know what depreciation is. It's pretty simple. It's just when you have assets, physical assets such as buildings or cars or machinery, and it just loses value over time. So that's depreciation. So because that's not actually a cash transaction, it doesn't get included in a cash flow statement. But so
what other things in particular do you look at, like revenue? Like obviously revenue growth. I mean, that doesn't have too much to do with accounting, but are there any other accounting-based things like ratios or anything like that you might look for?
Yeah, that's a good one. So I learned about this a bit in FP, which is financial planning, but we like to look at, so you have a current ratio, quick ratio, debt to equity ratio. They're just a few examples. Like they're simple ones. We'll keep it simple. So a current ratio.
What's the debt to equity ratio?
Yeah, put him on the spot.
A business's debt to equity ratio is a measure of the extent to which a company can cover its debt. It is calculated by dividing a company's total debt by its shareholders' equity.
Yep. So you can see that if you want to go back to the financials again.
What's equity? What's total value of equity?
One thing at a time here, John.
So, if you go back to the balance sheet, Swanee, can't remember what page that one was, sorry. 36 maybe.
36.
Yep, sweet. So debt to equity ratio. So a few things to look for. So debt's obviously liabilities. And then down there you can see equity. So we're not going to do it because I reckon that'd be pretty boring for the audience if we all pulled our calculators out and started doing maths on the screen. But that's what that one means, debt to equity ratio, obviously. And then, so another one we had was current ratio. Jonah, instead of putting Swanee on the spot now, I'll put you on the spot.
Yeah, go
current
on.
ratio. Tell me, current ratio.
I have no idea.
All right. So current ratio this time is just your current assets divided by current liabilities. Yep. Which is, sorry, Swanee, I'm going to make you put the financials back on the screen again.
Yeah, of course.
Again, we want to do this
Should have
because...
got that one, eh?
No, that's all right. Next time, mate. I've got another one for you. Be ready.
Swanee. Swanee hasn't answered one yet.
So, here. So, current, as you can see, current assets up there. Nice and bold. Pretty big. Easy to see. Total current assets. So, you get that number and you divide that by current liabilities, which is down below total current liabilities. Pretty easy formula to do. And that just gives you a ratio. And so, what you want to look for is you want that ratio to be obviously above 1, because if they have more current liabilities than current assets, that means if something were to happen to the entity and they had to pay out their liabilities, if their ratio was below 1, they wouldn't have the assets to be able to pay off their liabilities, which would put them in a lot of trouble. So you want to make sure you always have enough current assets to be able to pay off your current liabilities. Yep. And then another one, here you go, Jonah. Quick ratio. Very similar.
Is that just your current divided by your current?
No.
Current
That's
assets?
what we just did. So
I did think
so.
that.
quick ratio is just when you just pretty much only use cash. You don't include receivables, so you just use cash, and your current liabilities, so divided by your current liabilities. And so that one's another measure very similar to a current ratio, but just making sure you have enough cash to be able to pay out any liabilities if something were to happen. And it doesn't include receivables, which we touched on before. And it's probably a good one to do a quick ratio over a current ratio because, as we know and as we mentioned before, receivables aren't always reliable because there are sometimes when your customers or clients can't pay an invoice that you've invoiced them for. So that's another good one.
And the Investopedia definition is an indicator of a company's short-term liquidity position and manages a company's ability to meet its short-term obligations with its most liquid assets. Current assets minus inventory divided by current liabilities.
Yeah, perfect. So, that definition is very, very technical, but yeah. So liquidity is just a term used. So your most liquid asset is cash. So liquidity essentially just means something that's highly liquid means it's able to be translated into cash quickly. Whereas something that's illiquid it'll take a long time to transfer into cash. Like I'm sure you could find a better definition than that. But that's just the way I think of it. But that just extends onto what Swanee was saying before. But yeah, that's another thing I look at. And then another thing I look at as well, this one might be a little bit harder to understand, but so I'll just briefly touch on it. But you like to check if the share price is less than net tangible assets, which that just means if you go to you're in the balance sheet now perfectly. So your net tangible assets it sounds very complicated, but it's pretty much just your assets minus your intangible assets. As you can see in non-current assets down there, you have the intangible assets. So net tangible assets just means every asset minus that, if that makes sense. And so, that's just another one we look out for.
Great, thanks, Reuben. And where do people go to find to study financial statements, learn more about financial statements, cash flows, balance sheets, income statements? Any books you recommend? Any courses?
I'll be honest with you, I haven't read a book in quite a while, so I wouldn't have much of that. But there are a lot of handy YouTube videos you can look up. I probably wouldn't be able to provide a specific one, but there are a lot of little YouTube videos you can look up. Back when I was first starting and I had to learn about it a bit, I used to just look up a quick YouTube video. There's so many people who can explain it a lot better than I just explained it. But you can get quite a few little handy YouTube videos. And then even, just Investopedia, that website you just listed before, Swanee, that's a very good website. I like to use them quite a lot. They can sometimes be a bit complicated, but a lot of the time they're very easy to understand.
Swanee, I think you're on mute or something.
You're on mute.
Oh, sorry, guys. One of the books I read is Warren Buffett and the Interpretation of Financial Statements. That was very good and concept, but right back to basics.
Old mate Warren, he knows his stuff, I think.
You reckon?
Yeah, I reckon. Of course. If you're willing to read, for sure. But it's always good to just. It's definitely always good. We've touched on it so many times now, and I'm sure you guys are going to touch on it in many other podcasts to come. But it's so good to do your own research.
Yeah, 100%.
It's so important.
Do your own research, for sure.
Yeah, that's got to be the motto of this podcast, I reckon. Do your own research.
That's the motto of every podcast. But even like the biggest companies in the world, even just invest in things you understand. Like you want to don't invest in things you understand, but only don't invest in anything you fully don't get, or just stick to what you know. And
I remember when I first started talking to you, Jonah. I think this would be a couple years ago now, when we first started talking about what shares you had, because I was looking to get into it and stuff. Like, we pretty much just talked about blue chips because we know what they are. So
Yeah.
if you're very
And you've heard of them. You've heard of
Yeah.
like the big mining companies and
like you got Woolworths, BHB, Commonwealth
Yeah.
Bank, like they're just
Coles, all that shit. Yeah.
So at least you know what they do.
It's a good place to start.
Exactly. If you don't know much and you just want to get into the field, it's always a good spot to start. Just something you know.
Yeah,
And those
I think
companies, they're almost always making money.
Yep.
Yeah.
100%.
Good dividends as well, usually as well. So, all right, too easy. Well, thanks for your magical insights into the balance sheets and accounting, Reuben. It's good to chat, mate. Anything from you, Swanson, or you?
No, that's all good. Thanks for coming on the show, Ruben. I'm sure we'll have you back in the future.
Yeah.
We'll have a hit of golf
Cheers for that, boys.
in the near future,
Yeah.
mate.
Tomorrow, mate.
Yeah, let's make it happen.
Hopefully that
I got
wasn't
nothing.
Oh, beautiful. Hopefully that wasn't too boring for everyone. But yeah, keen to see how you boys go. I'm always
Bloody
here.
hell, thanks, Reuben.
How can people find you, Ruben? Do you want people to visit your LinkedIn?
Yeah. So my LinkedIn just Reuben Saric.
I'll attach
Just
in the
my name.
description as
Yeah.
well.
That's pretty much it. Eh.
Awesome.
yeah.
Stop recording.
Okay, thanks for coming on the show, Ruben.
Cheers, mate.
Thank you. See you later.
See ya.
Bye.